Welcome to Fundamentals, where I'm going to look at one of the most popular investment trusts on the AJ Bell Youinvest platform right now, namely 3i Infrastructure. Now this is an investment trust, a closed-ended fund, so anyone who buys this collective will buy shares in an investment company that trade on the stock exchange rather than units in a fund that can be bought or sold probably once a day. It's a big investment trust too, with total invested assets of around £1.7 billion, and the stated objective is to provide shareholders with a total return of 8 to 10% a year via the accumulation of capital growth in its projects and dividend payments from them. Managers Ben Looms and Phil White seek to do this by putting money to work in infrastructure schemes around the world. Note that most of the investments are in unquoted projects, not listed companies, so the underlying portfolio is not liquid, and this means it's ideally suited to the closed-ended structure, which gives permanent capital, and that means the fund managers, unlike their open-ended equivalents, are not forced sellers if you, the investors, look to sell for any reason. It also means this investment trust is best suited to patient investors with a long-term horizon, even if the £1.9 billion market cap means the shares should be relatively easy to trade, at least under normal market conditions. At the first half stage, the portfolio had 11 holdings, so you knew exactly what you were getting as an investor. By geography, Europe and Singapore represent just under 2/3 of the assets, the UK just over 1/3, and India the rest, as we can see here. By industry, utilities represent half of the invested assets and transport around 1/3, with telecoms and energy covering the remainder, as this second graphic shows. In terms of individual assets, well, the largest exposure was to Finnish electricity utility Elenia, followed by Anglian Water, a vehicle called Oystercatcher, through which it owns a stake in oil storage firm Oil Tanking, and then airport equipment leasing specialist TCR. Now, since the end of the first half in September, 3i Infrastructure has since acquired the landfill gas operations of renewables company Infinis for £185 million plus debt, a valuation above the previous fourth largest holding, TCR. Infinis had been quoted on the London Stock Exchange until it was purchased by private equity in 2015. Now, the net result of all of this is the investment trust offers a 4.8% yield via dividends that are paid twice a year, and the goal is to pay a dividend of 7.75 for the year to March 17, a 4% increase on the prior year, and we can see the historic dividend progression over the last decade right here. Now, also the trust share price has risen from just under £1 to 190p a share, with little volatility since its 2007 float, although do note that the ongoing charge figure is 1.4% a year, and, according to the Association of Investment Companies, that rises to 2.96% a year once performance-related fees are taken into account. So those are the mechanics. The question is, why would your fellow investors be potentially buying right now? Well, I think there are a few reasons. First, there's that steady capital return with just a few dips along the way, and that may be just the sort of performance which may appeal to investors who don't like too much risk. Second, that 4% dividend yield may well catch the eye of income hunters. And third, inflation's all the talk in financial markets right now, partly because of the Trump plan to cut taxes, spend on infrastructure and deregulate, and also because oil prices are rising. However, infrastructure operators often have pricing mechanisms that are linked to inflation, and so they can offer some degree of protection against rising prices. Now, there are risks, as there are with any investment. Patience is going to be required for these infrastructure projects to bear fruit, especially as 3 quarters were operational and 1 quarter was not at the end of September. Also note those chunky fees can chew up some of your returns. And finally, do note that the 190p share price compares to a net asset value per share figure of 162. That's a 17 to 18% premium. That means in effect you're paying £1.17p to get your hands on £1 of assets. Now, that's not unusual for the infrastructure category within the investment trust universe. The next graphic shows the average premium to NAV is 12.6%, that's the black line, with 3i Infrastructure right at the top. You could argue this premium is merited, as on a 5-year view, 3i Infrastructure is the best performer in the investment trust sector for infrastructure as measured by its share price. And also, this actually isn't the highest premium to NAV ever seen for the shares, as shown by this final graphic. The shares did briefly trade at a 22% premium in autumn 2016. So the assumption is clearly that the assets it owns will keep rising in value. But if the fund is seeking 8 to 10% returns a year, you're effectively giving away 2 years of returns or 4 years of dividends in return for the relative security of capital offered by the historic return profile. Now, you may feel this is a good deal, particularly actually if the Trump trade fades and uncertainty returns, but only you can know whether this valuation and investment trust fits with your overall strategy, target returns, time horizon, and appetite for risk. So thank you for watching, and I look forward to seeing you next time.